Hello and happy January 10th. This is the day of the big USDA set of reports, the biggest data dump of the year from USDA. So it's known for its surprises, and USDA didn't disappoint. This is Arlan Suderman, Chief Commodities Economist at StoneX. And we're going to talk about those surprises in today's report. But first, we're going to put it in the context of the market that we had coming into it. What was the money flow? And as those of you who have followed me before know that I believe that money flow is a big part of it and how the market is going to react. Price is a function of supply and demand. The market still is impacted by supply and demand, but how the market manages supply and demand is impacted by the flow of money. So we're going to take a look at that to start off with. First of all, we got the big monthly jobs report this morning showing that the unemployment rate had dropped to 4.1% in December. Job creation was about 100,000 jobs more than what the analysts expected. And the November and October numbers were revised higher as well. So the job outlook is looking better, and that reduced the odds that we'll see a rate cut from the Federal Reserve anytime soon. Now, as we look at the inflation numbers, the latest inflation numbers available, we still do not have the December inflation numbers yet. We see that inflation has started to tick higher again. Is this an aberration, or is this more of an extended trend? That's the key question that the Federal Reserve is trying to determine. Their comments seem to indicate overall what their general comments from their statement is that we're still heading toward a 2% mandate. Individual members of the Fed aren't convinced of that. And so based on the minutes of the meeting, it looks like we're getting closer to more of a 50-50 split, which would suggest that we're looking at a pause in the rate cutting cycle. It's interesting to note that we have seen the Fed since September 17th cut their benchmark rate, which is a short-term overnight rate, by 100 basis points, with originally expectations to go another 100 basis points or so lower. But that is kind of blown away in the wind right now. But meanwhile, we have seen yields on 10-year treasuries in that same period of time that the Fed's been cutting 100 basis points go up by about 115 basis points, go in the opposite direction. So that tells us, and I've got a chart to show you that in a little bit. I'm going to jump ahead to, no, I'm not going to jump ahead to that. Let's back up here. I'll come back to that. This is, again, a chart that I've been maintaining showing inflation following very closely, albeit on a different scale, the cycle that we had in the 60s, 70s, early 80s. Now, just because it's followed it to this point doesn't mean that it needs to continue to follow it. But human behavior does repeat itself, and the Fed did give in and cut rates, in my opinion, too soon, too much. So does that mean that we have now overstimulated the economy? Now, this chart didn't know who was going to be elected president, but we elected a president who favors tax cuts and deregulation, which tends to stimulate an economy at a time when we're cutting rates, which is also stimulative of an economy. We still have a lot of fiscal stimulus in the economy. So that means that in order to try to reduce inflationary impacts, we need to see a cut of fiscal spending. Will this administration be successful at doing so? They've established the Department of Government Efficiency with a goal of cutting government spending by 30%, but will they be able to accomplish that? That's a big question going forward. Now, as we look at why is the economy doing so well? Well, 70 to 75% of our economy is based on the consumer. It's a consumer-driven economy. And look what's happened to, this comes from Real Clear Markets in their survey, their economic optimism index. Look how it has spiked since the election to more optimism. And that means consumers spending more, generating energy, the animal spirit, so to speak, of the economy. And that can be inflationary if you have too much money in the system when that happens. Now, where are they getting that money from? Well, first of all, while interest rates have gone up while the Fed has cut interest rates at since September, that is, they had raised them prior to that. So mortgage rates are high. And now with 10-year treasuries, they're going higher again. The average rate on a mortgage in the United States right now is right at 4%, with home values going up. So that means the consumers have more wealth in their assets. And when they have more effective wealth in their assets, it's the wealth effect, they tend to spend more. And that's what we're seeing happen, in addition to the fiscal spending. And so why hasn't it slowed down the economy at the corporate level? Because corporations are able to lock in interest rates. And with interest rates near zero for so long, they did so. And they locked in interest rates at very low levels, and which is what we see in this chart. We're seeing corporate net interest payments near record low levels. I mentioned home equity lines of credit are expanding because they have so much equity in their homes. Homes going up in value because we have a shortage of houses in this country. And so values of homes values keep going up despite the sluggish housing industry. The values keep going up, making new record highs, even though homes aren't moving, because every time we do see a dip in interest rates and consumer sentiment go up, we see a surge in demand. And so house prices are staying up there. Equity lines are there because equity is growing, and so consumers have more to spend from that standpoint. Now let's look at the fiscal side of it. We're basically locked now at this 36.3 trillion dollar national debt. That's because the agreement reached between Congress and President Biden in June of 2023 to suspend the debt ceiling until January 1 of 2025. Well, it's now after January 1, 2025, so we can't borrow anymore. But we're still in deficit spending. So that means the Treasury Department is currently needing to be very creative in its accounting to move money around to try to pay its bills. And it can do that for a period of weeks, but it can't do that forever. And so therefore, Congress is going to have to deal with the debt ceiling. They've got to cut spending, increase revenue, suspend the debt ceiling, raise the debt ceiling, whatever they're going to do, they've got to do something here in the weeks ahead. And so one of the priorities of the Trump administration is to get Congress to come to some type of an agreement on that. If you look at the center there, we see that the annual interest on that debt is at $1 trillion. That's more than what we spend on defense each year, $871 billion. Social Security is $1.5 trillion per year. Medicare, Medicaid at $1.66 trillion. You add those four things together, which to some extent are somewhat untouchable, and it comes to about $5.03 trillion. But look up here in the center of the top, where U.S. federal tax revenue is projected at $9.4977 trillion. So those four things alone put us in a deficit, and we haven't even touched the discretionary part of the budget, USDA programs, food programs, Homeland Security, Veterans Administration. I could go on and on and on about the rest of the discretionary programs, which are about another $1.75 trillion. So if you're going to cut the budget by 30%, you essentially have to cut all of discretionary spending. That's not likely to happen when that approval has to come from people who want to get reelected. That's the problem right now. Right now, our annual deficit is at about 6.4% of GDP. France ousted its government with a no confidence vote because it was trying to reform Social Security to cut its deficit spending from 6.0% down to 5%. Germany just ousted its government with a no confidence vote over its problems. I mentioned France's problems. Canada did the same thing. South Korea, we have the ousting of a government for other reasons, but also that's a number of our top GDPs in the world now facing new governments, and a lot of it's over these fiscal irresponsibility issues. Now, when we talk about Social Security, 73 million people receive Social Security benefits. How many of those 73 million Social Security recipients do you think vote? No doubt most of them do. If you add Medicaid on top of that, it takes it up to about 78, 79 million people. It's a lot of voters that Congress doesn't want to upset. That's one of our big ones as far as spending goes. 2.7 million people work in the federal government. Most of them are working from home. The Trump administration has said you have to go back to the office. The Biden administration tried to give a large chunk of these critical workers the option to stay at home for another 5 years. Something's got to give. What will it be? If we look at the U.S. economy, the outlook is trending higher, as we see here, trending higher. As we look at Europe's economy, it's trending lower. Now, when you look at the dollar index, the biggest competitor to the dollar in world trade is the euro. So if you want to trade it in the various markets, where are you going to trade between these two options? You're going to trade in the U.S. markets. To do that, you have to own dollars. So you have to buy dollars to do so if you're in another country. That keeps driving the dollar higher, and the euro is going lower. The dollar can't break. It's very difficult for the dollar to break if the euro's going lower, because the euro is such a big part of that dollar index basket. And so that is creating headwinds for U.S. exports. And it does help offset. It gives us better buying power for what we import. So you worry about tariffs, the 10% tariff or whatever it be, as strong as the dollar is, we're really offsetting much of the cost of the tariffs, depending on which country you're talking about. We'll talk more about that. Here's that. The blue line shows what typically happens to 10-year yields before and after a Federal Reserve cut. Notice how they keep trending sideways to lower. But this year, the green line shows what's actually happened. So are the markets are trying to tell us something. Are they trying to tell us they're concerned about the fiscal spending problem, where we're having a continual increase in the supply of debt certificates, but we're seeing a lack of buyers? We've had a couple of auctions that haven't gone well, some that have, some that haven't. And that's been helping to push those treasury yields up. Because when you increase the supply of debt certificates, but you have a soft demand for those certificates, the value goes down. It's just like increasing the supply of corn at a time when demand is low. What happens to the price of corn? It goes down. Well, when the price of value of treasuries or bonds goes down, the yields go up. That's how they're designed. That's how they're created, to try to attract more buyers. Could that be it? Could it be that the market's trying to tell the Fed you shouldn't have cut rates? That's one possibility as well. Is it trying to say we need to worry about inflation? Maybe it's some of all three, but the market is trying to tell us something. Now, as we look at U.S. fiscal policy, it is on an unsustainable path, in my opinion, and it has long-term implications for the markets. We did get a continuing resolution last month to fund the government until March 14th. So we're going to revisit this again. And from what I hear right now, incoming President-elect Trump is working with congressional leaders, trying to put together a package that would fund the government for the rest of the fiscal year, in addition to dealing with the debt ceiling. But with a very narrow margin in the House and the Senate, that could create some problems. The Democrats had the same problem when they had all three. And so it means that a couple individuals can hold out saying, I want what I want, or I won't join the party and vote for you. Excuse me. I've been doing a lot of interviews today and a lot of talking, so hopefully I will be able to keep my voice. And so it's going to be essential if Trump's going to get what he wants to get, to be able to keep everybody in the camp. Now, the first test of that was an approval of Mike Johnson as Speaker of the House for this Congress. And that looked pretty iffy. In fact, it looked very doubtful. But Trump came out strong in his favor because he knew that the last time they deposed a speaker, it took weeks to find a new speaker, which would have delayed his agenda. And at the last minute, those who were holding out did fall in line. Now, we don't know if they got any type of a deal in order to do so, but they did fall in line, which is a good sign that maybe he'll be able to get them to fall in line as we go forward, but we don't know that. So that's a risk. Now, sovereign debt credit downgrade is a risk at any point. And based on what these credit ratings agencies have said, particularly it is a risk if they see political gridlock in solving the problem. They have warned that our fiscal spending is unsustainable, our debt problem is unsustainable. They want to see our Congress do something about it. They're probably willing to give the Trump administration some benefit of the doubt since they have campaigned about cutting spending, that they need to see some movement. So that's something we have to watch. Steepening of the yield curve, I believe, is a signal of coming issues. Back on September 17th, that yield curve was at about 5 basis points. Overnight last night, it was over 40 basis points, 42, 43, somewhere in there. And so we'll need to watch these continual Treasury auctions. We've had a few that have had some weakness. And we've seen some of the investors who have been supporting this drawing their money elsewhere because there's been other attractive options. Now, the higher yields get, the more it draws them back. So that does help solve it to some extent. But what is that level of balance where yields get high enough to draw sufficient number of investors? That's what the market's trying to find right now. If we look at the coming fiscal battle, and I've already talked about most of this, it's interesting to note that Argentina is actually having success at cutting its spending, but that only comes after tremendous pain suffered by the people, the voters of Argentina, of 200% plus inflation. Can the Doge group be successful at cutting spending when our U.S. consumer hasn't experienced that level of pain? That we don't know yet. But controlling inflation necessitates it. If you're going to cut taxes and deregulate, that's stimulative of the economy. And we didn't see inflation in Trump 1.0 prior to the pandemic. We didn't. But we didn't have the level of fiscal stimulus in the economy at that time with all the government spending that we do now either. Now, let's tie it to the commodities. What are we seeing? Well, if we look at here, since we last met, we're seeing inflation expectations on the 5-year break even kind of go sideways, neither higher nor lower. Now, there was a consumer report that came out today, a consumer sentiment report that the market traded, and we saw another sell-off in stocks. They sold off on the jobs report we got this morning, which I mentioned earlier, and they sold off again when this consumer sentiment report came out because it showed a significant increase from last month in inflation expectations. I think it was going from like 2.8% to 3.3%. So consumers are starting to expect more inflation. Perhaps the market already had that priced in there and the rise prior to that. But that's one of the keys. But notice the correlation here between inflation expectations on the 5-year break-even inflation rate, what will average in inflation next 5 years, and our StoneX commodity tracker of 20, this basket of 27 commodities is 0.86. Anything above 0.7 is considered to be statistically significant. So 0.86 is pretty solid. If we look at the 2-year break-even inflation rate, we see those expectations have already gone up here by well over a full percentage point, over 100 basis points. But now they're going sideways. If we look at this overall StoneX commodity tracker versus the CPI, the Consumer Price Index, well, it's diverging some here over the last year. And the correlation is still significant, statistically significant, but it is a little bit weaker because of the weakening we've seen of late. And we'll break that down a little bit. Grain and oilseeds still at 0.88. Pretty good correlation here. Amazing correlation, frankly, between grain and oilseed values and the CPI. If we look at the livestock, that's where we've seen one of the areas where we have seen protein prices continue to trend higher, while the CPI has been trending lower over the past year and a half or so. And that's because of the tight protein supplies that we've seen in the United States. If we look at the energy subtracker, just like grain and oilseeds, pretty close correlation, 0.88, pretty strong. And that makes sense because energy goes into about everything we do, not just in hauling and then travel, but in packaging. Most of our packaging is made out of fossil fuels. So it really has a big impact on about everything. If we look at the value, it's the net managed money positions in the grain and oilseeds and the livestock combined, we're continuing to maintain a modest long position. That's largely because of very large positions in the protein sector and a very much growing position in ownership in corn versus some pretty weak some pretty short positions, good-sized short positions in soybeans and wheat. And I'll break that down for you a little bit later. If you break it down by sector, overall, we've seen a little over 5% growth in this 27-member basket of commodities, the StoneX commodity tracker, over the past 12 months. With each sector in positive territory, except the grain and oilseeds. Grain and oilseeds losing about 15.5% here. Now, when we update this is what I had when going to compliance, and we update that should fall to about 12.5% because of the end of the year gains in first of this year, about 12.5%. But regardless, double-digit losses in grain and oilseeds, positives everywhere else. And I think that's one reason we saw some managed money come back into the grain and oilseeds over the last 2 weeks, just saying, oh man, grain and oilseeds undervalued compared to the rest of the sector. This is a rebalancing time, and we're looking at it. And but it gives you a breakdown of the different sectors there. If we look at the expectations, I covered this last month as well. The 25% tariffs on Canada and Mexico, 10% on China until the borders are closed to illegal immigration and drugs. And I still believe that Canada and Mexico will see an agreement. It may not be a printed agreement, but something leaders agree to do. It's going to get interesting, though. I expected the first agreement to be with Canada, and that was before Justin Trudeau indicated he was ready to step down. Now, he's still officially in his position until a substitute is found. But that was pretty significant. Mexico with President Sheinbaum, I think that it'll be an agreement under cover, so to speak, because she needs to look good in front of her electorate. She's a brand new president, I think started in October. And so she can't look like she's simply giving in to Trump. And I think Trump understands that. So she may say one thing and do another. And we're seeing evidence of that already. China's going to take some time. The fact that Xi Jinping will not attend the inauguration, I think, is an indication that things will probably stay cool for a while. But the fact that he is sending a couple of his top leaders is an indication he still does want to melt the ice somewhat. And so we'll look for that to happen in months rather than years, I think, as we go forward. Excuse me. Okay. So I do think that there is a good chance of a trade agreement, but the fact that Xi Jinping is not coming to inauguration reduces the odds of us seeing a late January purchase by China of significance as a goodwill measure, because that usually happens ahead of state visits with China. But it doesn't necessarily mean that we might not have an agreement, say, over the next 6 to 8 months. What will Trump's support for biofuels be? If a trade war breaks out, does that improve that chance or not? Where does Trump stand on biofuels? We were hearing today, and we saw a big surge, actually started late on Thursday, on January 9th, for those you watching the on-demand version, with wire service reports that the Biden administration would release these 45Z guidance indicators. But they indicated this is just guidance, that it still has to go through a lengthy comment period, which will take it beyond the transition period in power of January 20th, and that they're going to leave it up to the Trump administration to implement. Well, this is all part of the very subsidy program itself, is part of the so-called Inflation Reduction Act passed during the Trump Biden administration. And President Trump has indicated that he wants to abolish the Inflation Reduction Act. Now, he hasn't indicated he wants to do it because of the biofuel support part of it. He's just a lot of things in it he doesn't like. So I guess he could abolish it, but still provide support, but that might take additional legislation. What we really fear is, even though the soy oil market rallied on these wire service reports of this, it doesn't give producers of the biofuels any confidence to really commit the money necessary to buy the feedstocks if they don't know if they're locking in a loss or not. And what we fear is we may be at the same point of uncertainty 6 months from now, because we don't know where biofuels fall in the priority list of a very aggressive Trump agenda on the Trump team. We don't think it's really at the top of the list. So they may be supportive, they may not be, but we may not know for many months. That's our fear. Black Sea, Red Sea geopolitical risks we see calming right now after January 20th. Based on comments, that's the market expectation. I've already talked about Xi Jinping. I do think he maintains his goals. He's going to play the long game, but he's in a weak position right now, and I could see him coming to some agreement that would last through the Trump years. So we'll see how that plays out. And this again shows you the trade imbalance that we have with China, Mexico, and Canada. Let's talk about the weather. Here's a look, and we see how cool we are in the equatorial Pacific. We actually touched moderate strength La Nina status. We really believe that the climatologists I talked to believe the La Nina is peaking right now and is going to trend weaker in the weeks and months ahead. But if you look overall, what's key? It still comes back to, do we have cool waters here and do we have cool waters here? Doesn't matter what we have right now, but for our growing season, what is it like here in June in these two places? Will it be cool in June, or will those waters be warm? What will they be? Because if those waters are cool, what tends to happen is we tend to get high pressure right here, high pressure right here, and then high pressure right in the middle in the northwestern Midwest. And that sets up what we call an omega block with stagnant air, loss of momentum in the atmosphere, which leaves us hot and dry in the Midwest. If we're warm in these areas, in the Gulf of Alaska and in the Baja of California area, then we don't get this setup. And we tend to see this high pressure move down here, which is the Bermuda High, and the flow around it pumps moisture up into the Midwest. And that gives us a good growing season if these waters are warm. But if these waters in the Gulf of Alaska are cold, we get this triple ridge effect. So that's going to be the key. Not how are they now, how are they in May and June and going into the summer growing season. Now, if we look at November and December precipitation ranks, wherever you see a 1, that means it was the wettest of the last 133 years for that climate reporting district. If you see a 133, that means it was the driest. We came close to that in the Southwest. So you can see we're generally seeing dry conditions there. We saw some significant improvement here, but we still have some dry soils. Where do we go from here? Here's the temperature ranks overall. We're paying the price for that now. So while we had a very hot 2-month period in Texas, now we're seeing this cold air funnel down out of the Northwest, even Arctic air coming down. We have dramatically improved our topsoil condition. But on this graphic, I'm looking at the top 100 inches, which is, 100 centimeters, which is about 40 inches. In the past, I've shown you the graphic of 40 centimeters, which is 16 inches. And most of the red and orange has disappeared off of that map. So I went to the 100 centimeters to show you we still do have some issues in the profile. Still very dry in this Great Lakes area, central and eastern Midwest. Very dry up here. And the odds of us continuing to see right now, as we mentioned, we've been very dry in this area, and that is expanding. And the concern is, will that expand back up here into the northwestern Midwest and the western Midwest? That's the concern that we're monitoring. If you look at previous years with a weak La Nina winter and the growing season that followed, looking May to August, we tended to see a dry Midwest with heat in the central and western Midwest. Now, 2009 is also in that list, and 2009 had a near perfect growing season. It still comes down to, do we have warm waters in the Gulf of Alaska and off the Baja of California? Do we have cold waters? If we have cold water, we're much more likely to have this scenario, which is about 60% of the time. So that means 40% of the time it was good. 60% of the time it was hot and dry in the Midwest. So it's a much higher risk, but it's not a guarantee. So I wouldn't base my marketing plan on thinking, well, we're definitely going to be hot and dry. But you do need to base your marketing plan on that risk, particularly after today's crop report. And I'll go into more details. Today's crop report really is critical in light of this graphic. If we look at Brazil, this is the rainfall they've had October 15th through December 31st. On average, that's about 15.5 inches of rain. No, a little over 15, about 15.25 inches of rain. That's quite a bit in 2.5 months of time. Now, it is below normal. It is one of the drier periods that they've had. And you can see that they are trending drier. But it's still enough that we have seen really good yield development in the center west area. Now, if we look at the outlook for January, southern Brazil and much of Argentina is pretty dry. We have had showers in this dry area. That has happened. So it's not totally dry, but overall it's much below normal. We've had above normal rains in this area. That includes center west Brazil, a highly productive area. So what happens going forward? Well, this is on the right-hand side, we see that the areas that were dry for January are seeing better precipitation, either normal or above normal precipitation. And many of the areas that were wet start to dry out to facilitate the harvest and the planting of the safrinha corn crop. Now, confidence out that far can be weak. If that happens, that would be good, because you see the dry areas of crop development is still happening, get rainfall. Wet areas that need to be able to dry down the crops and harvest and plant the winter corn crop, they dry out for facilitating that. Then we need to look at what happens after that period as we get into March and April and May for seeing the winter corn crop develop. And that's out there quite a ways. Okay, today's report. Let's get to the numbers. Winter wheat acreage at 34.1 million acres, above the trade estimates of 33.4 million acres. And you see that overall, our numbers were among the highest in the industry, but among the closest of the ones as well. Hard red winter wheat acres at 24 million, an increase from 23.787 last year. Soft red winter 6.44, that's an increase. White winter 3.64, that's a 100,000 acre increase, overall an increase in area. Here we see the state by state breakdown. Kansas and Oklahoma lost 200,000 and 100,000 acres respectively, but that was all picked up by Texas. You can see that Ohio was a big gainer in acreage, modest gains in Illinois and Indiana. Missouri was a loser, so was Kentucky, Tennessee. And you can see here how it all plays out. Montana, big increase in winter wheat acres, 300,000 increase. So all the pluses and minuses in total, it came to a gain of 725,000 acres. Now, we still have to grow the crop. We have to bring it out of dormancy. We have to weather the weather scares, so to speak. But this was one of the factors that limited gains in wheat today after the report. Quarterly stocks for wheat came in almost exactly as expected. Corn came in, roughly 70 million less than expected. If we look at soybeans, 3.1 billion bushels, that was over 100 million bushels less than expected. So when USDA is looking at this, they tell me they have the greatest confidence in their production surveys, but they look at these December 1 quarterly stocks report, all stocks in all positions. They say, we know mostly what demand is. We must have overstated the size of the crop. Remember, it was dry at the end of the year. Our customer survey, frankly, didn't show this decline in production. But when December 1 stocks didn't show the bushels, that means the crop must not have been there. And so, as we look, USDA cut corn yield by 3.8 bushels per acre, 3.4, excuse me. Cut soybeans by a full 1.1 bushels per acre. Actually, I'm looking versus our estimate. Yeah. So we're seeing, exactly 1 million acre reduction in 1 bushel per acre reduction in soybeans. So significant reductions in yields there. There were also some changes in acreage, but you see this has us creeping below the 30-year trend yield. Having trouble getting up there. Still a record yield that we see here. 179.3 is a record. But as we look at the trend for next year, we carry this trend out. Next year, we need to be at 183 bushel per acre yield. We've never achieved that. Can we do that next year? Well, that may be a challenge if the warmer, drier conditions that we fear do develop. If we look at corn yield changes from November, we see some pretty significant changes. Now in Kansas, we saw a 9 bushel decrease, Nebraska 6 bushel decrease, Wisconsin a 7 bushel decrease, Minnesota a 9 bushel decrease. So a lot of reductions. Then we go to Alabama, not a big corn producer, but a 12 bushel increase, 21 bushels in Georgia, 11 in South Carolina. Where were we at? That would be Virginia, 19 bushel increase. So a lot of big changes by USDA. If we look at harvested area, there were some significant acreage changes. Now, nationally, we only added 186,000 acres to harvested area, but there were some pretty significant state by state shifts within that. Soybean yield, taking that dip, staying below that 30-year trend line. Where will we be next year? If we look at yield changes here, we see Ohio, probably the most significant, 3 bushel per acre reduction. Yeah, you can see Texas at 8 bushel per acre reduction, but Texas is a pretty small portion of national production, not one of the Midwest states or not one of the major production states. If we look at area, again, total area down by 221,000 acres. We saw some significant acreage reductions in the plains. And so that accounted for most of the loss. Where will we be in 2025? As we look at 2025, we're seeing some interesting trends in seed sales, which suggest we could have some significant increases in corn area this next year at the expense of soybeans. The exception being here in the Mid-South, where I think we could actually see an increase in soybeans. South American production, no change from last month. Really kind of surprised me we didn't see USDA increase its soybean production estimate for Brazil. I still believe that's coming. U.S. ending stocks, not much change for wheat. The big loss was in corn. And as I said, that's at about 10.2% stocks to use ratio. That leaves us vulnerable if we do have that weather problem I mentioned that was a potential for this next summer. 380 for soybeans. Now, why wouldn't the market get excited? Well, it did get excited about that. It was the biggest gainer of the day. But yet USDA kept the marketing year average cash price for soybeans unchanged for this year. So what is USDA saying? They're saying the market probably should not have rallied. It's saying that South America is going to have a big crop. It's saying that we don't have a reason to ration demand with higher prices. We'll see. Global ending stocks, seen corn go down by several million metric tons. We're seeing wheat go up modestly. We're seeing soybeans drop by about 3.5 million metric tons. Corn export sales remain strong. Unknown destination is the biggest difference year on year. That other year that's up there is the 2020-2021 marketing year. If we look at export shipments, marketing year-to-date inspections exceed the seasonal pace needed to hit USDA's target by 60 million bushels. And that's after USDA cut its export target today. If we look at ethanol corn usage, well, we're running almost 30 million bushels above the seasonal pace needed to hit USDA's target. Why has ethanol production been so strong? It's been exports. We've seen a real increase in exports. Canada being the #1 target, and that's helping keep our margins going for grinding corn, making it in ethanol. Managed money. Well, look at this big long position it's building right here. The correlation coefficient is 0.69. So as managed money increases ownership, we tend to see prices respond. That's what we're watching. If we look at the corn balance sheet, you see here on the left, USDA's numbers. I mentioned a 15.4 billion bushels gives us a 10.2% stocks to use ratio. I'm at 9.8%. They're very close to each other, really. It doesn't give us much cushion because look, we take that 1.49 billion bushels, we put it in our beginning stocks for 2025-26 marketing year. I use a trend of 183. I increased my acreage after this week to 93.5 million. That's up almost 3 million acres. Now, that's still a moving number where we're at, but that's where I put it today. Gives us a 15.6 billion bushel crop. Throw in the demand estimates that are developed from my global balance sheet. Ending stocks are 1.782 billion bushels. That's adequate. What that says is there's no reason to rally corn prices to ration demand. Now, the market did rally today, and Brazilian farmers are thrilled because they're making final planting decisions now for their winter corn crop, the safrinha corn crop. What if corn acres don't increase? Well, that draws stocks down even more, below 1.3 billion bushels. What if they go to 95.5 billion acres? Well, that pushes ending stock projections over 2.1 billion bushels again. Let's look at the biofuel program once again. This is looking at soybean oil plants, new and existing plants, and where they're kind of concentrated. Now, let's look at it another way. All those new renewable diesel plants can very easily switch over to producing sustainable aviation fuel. So FarmDoc at the University of Illinois published this table showing those nameplate production capacities for these various plants. That's existing plants and what they could produce over the next couple of years. But this is showing planned plants that are yet to reopen that could switch over to renewable diesel towards sustainable aviation fuel, or existing plants that could be switched over. So you see, we have tremendous potential for expanding our sustainable aviation fuel production. The problem is most of our ethanol, and doesn't qualify, and we don't have a 45Z program to say how the rest of our feedstocks would qualify, even with what the Biden administration is now releasing. If we look at soybean inspections to date, they exceed the seasonal pace needed to hit USDA's target by 133 million bushels. Now, I'm expecting this to continue to nosedive because our beans are simply more expensive than Brazil going forward, and by a significant amount. 80 cents for anything shipped now for February delivery, over $1 for anything for March delivery. Export sales to China are not where that comes from, though. China continues to ratchet down its purchases. If we look at sales to unknown destinations, they're not that much more significant than last year. So we do see in 2020, we did have that big unknown destinations ownership that was pretty big. And as they get ready to freight it, you get freight lined up, then that switches to whatever country is going to take it. But as I've looked through the data, it's a lot of other countries, non-China countries, that have been buying up soybean supplies at the cheap prices that we had. I want to show you this again. Notice how we see this growth in soybean acreage really grow dramatically since July of 2011. That's really kind of the turning point when we saw a significant uptick. What happened then? Their currency really lost value. It went from 1.53 rias to the dollar to well over 6 rias to the dollar. So $13.50 soybeans back in July of 2011 is what the U.S. farmer got minus basis. And the Brazilian farmer priced his off that market as well and then converted it to rias. So that converted to about 20.6 rias to a bushel back then. Today, it's almost 3 times that much at over 60 rias to the bushel, encouraging expansion of soybeans. If I look at my soybean balance sheet, first of all, let's start here on the left-hand side, which is USDA numbers at 380 million bushels. That's about 8.7% stocks to use ratio. I'm at about 8.5. But notice USDA didn't cut its crush estimate. I have. Have I cut it enough? I don't know. Have I cut it too much? Probably only if we get some clarity from the Trump administration real quick. That I don't know that I expect that. I see I've got an error here for next year. I kept it at 2.53. I don't know that I can justify that until I learn more from Trump administration, but not knowing if it's going to be higher or lower, I left it the way I had it before. Exports, I have a little bit higher than USDA, so I come up with ending stocks at 370 million bushels. Managed money, building short positions in the soybeans. We look at wheat, not a lot of changes to the balance sheet today, some minor ones overall. In the end, we're looking at adequate wheat supplies, no real problem there in the wheat market. Hard red winter wheat supplies are the big surplus right now. On the other hand, white and soft red winter are where we have our tightest supplies, so to speak. But here's the story. We're looking at stocks trending lower among the major exporters. And they're getting at pretty significant low levels as measured by stocks to use. Right now, we're seeing a tightening up of exports coming out of the Black Sea. But Argentina and Australia are making that up right now, and we'll continue to do so over the next several months. And then will the market have to come to the United States? That's the question. If we look at Chicago wheat, pretty large short position down here. If we look at Kansas City wheat, pretty substantial short position right now. Minneapolis wheat, pretty short position overall. Now, what's our take-home points? And then we'll take questions. I see many of you have been entering your questions in the Q&A section already. Today's revision removed the corn safety net. So if we get a weather problem, be it in Argentina, Brazil, or in the Midwest next summer, it's at that point that the market could be expected to sustain a rally to ration demand. Today's rally simply bought more corn acres in Brazil. The revisions were cheered by the Brazilian farmers because it raised prices that they could lock in. Wheat acreage did increase, but Black Sea supplies are dwindling, and it's a Black Sea that sets the world market. Brazil is expected to harvest a big soybean crop, and it's actually, we've seen the first fields cut already. We'll see that momentum really pick up the last week of January into February. But what's the U.S. demand picture going to be like? That's real suspect at this point. What will 45Z guidelines be? U.S. tariff options, what will happen there to use cooking oil? Some of the reports out today will saying that the new guidelines won't subsidize used cooking oil for sustainable aviation fuel, or maybe for green diesel. So I have to go back and double check that. Yeah, it won't support it for green diesel production. So that would tend to shift demand to used cooking oil. Although U.S. used cooking oil then might switch to the green diesels. So I have to watch that. What will happen with the 45Z guidelines? Will they end up being law? Will they not? We got a lengthy comment period and then see what the Trump administration says. The weather risks are elevated for this upcoming 2025 Midwest growing season. We don't know what that means. It could mean anything from 2009 to 2012, two extremes that we've seen in recent years. We'll have to wait and see what water temperatures do in the Gulf of Alaska and at the Baja of California. Geopolitical risks are rapidly changing. Is that going to be a positive or negative? Depends on your perspective and what happens. So with that, I'm going to wrap it up. and I'll get through as many questions as I can here. First of all, Marco asked regarding bean exports, USDA is running ahead of USDA's goals, but it did not raise the export number today. Do you attribute this decision to likely trade war scenario or the total supply of beans that has been lowered sharply? Overall, um, overall, I think it's because of they're worried about U.S. exports dropping off sharply. All the questions is about tariffs, and they don't mean a hill of beans right now, if I can use the terminology, because tariffs or no tariffs, China isn't going to buy many U.S. beans in the next 6 months because Brazil's going to have plenty of soybeans that are going to be priced 80 to $1.20 cheaper than U.S. beans. So why would they buy ours? And so tariffs start becoming a factor next summer when China is going to be buying from the U.S. for fall shipment. That's when it becomes a factor. Now, your question's still a good one. And that doesn't mean that what I believe is what the market is actually trading. But I don't think it raised the export number because it knows that China is rapidly going to be going to Brazil because they're frankly cheaper. What did happen to the total supply of corn and beans in this WASDE? It comes down to smaller crops, smaller yields. In beans, it was lower acreage, a little higher acreage for corn. The question is, why didn't USDA pick up on this in November? Because most of the crop was harvested in November. It should have. Question 3, will Trump lower biofuel mandates in his first moment? No, I don't think he will, because I think it's low on his priority list. That's the problem for the industries. We simply don't know. We don't know if he'll support it or try to get rid of it. We don't know. It's a big unknown. Fourth question, if biofuel policy is not the top list of Trump team, is it safe to say that the EUA, I assume it means EPA, will be in a standoff, or is it will follow the Biden's program? Now, it really can't follow a program that isn't law. And so a Trump administration, how will they respond to it? And that's simply something we don't know. Keith asked, do you have a theory why managed money's net long and corn net short on wheat futures? First of all, managed money likes trading Chicago wheat short. Kansas City, it'll trade either way. But it's looking at these big U.S. supplies. We are the residual supplier of the world. World fundamentals are improving. They're notably better than they were 6 months ago. But we still have the big U.S. supplies. So why build ownership in it until we actually see that demand start to shrink those supplies? Why ration demand with higher prices when we need to get rid of it? John asks, with good weather from this point forward in Argentina and Brazil, their soybean production could increase 650 million bushels over this past year. I can't see new demand covering over half of that, which could push 300 million bushels to our 25-26 ending carryout. Downside price risk with that, given a strong U.S. crop this summer, and I fully agree. Brazil's crop actually is almost made. Argentina is still a question mark, but I don't see anything yet to get all panicked about, especially if the European model is right that rains return as we get into February. So we'll see. Confidence is low that far out, but it's still tough for me to get excited about the soybean market. When I look at today's rally, with the questions we have about domestic demand and with the big Brazilian crop, that doesn't make sense to me. Obviously, my bias comes through in that. So that looks like that's all the questions, and we are at the top of the hour. So with that, I will conclude today. I want to thank you again for being here today. We will be back in February after the USDA reports in February, and we will know a lot more about the weather pattern in South America at that point. And we will have our updated estimates for planted acreage for the Midwest for this next growing season. And we will know more about the Trump administration and their policies, be it tariffs. Will we know more about the 45Z guidelines? I don't know. But if we do, I'll share that with you in anticipated expectations. So I look forward to being with you then, and we'll see you next month. Thank you very much for being here.